Caitlin, all right, you might nerd out a little bit here because you can maybe talk to us about the philosophy at Skye. Caitlin said, run me through stepped versus level premiums again.
All right. Well,
strap in, kids.
Yeah, strap in, because what's even better is the regulator made changes to those terms. So now they're actually called variable age stepped, which is the old stepped.
Good.
And now the new level term is variable to age 65. If I gave you those two terms, would you have a clue what they are?
No, that's ridiculous.
I literally have to work it out every time. I look at
variable
a quote.
to age 65
is
because
level.
At age 65, the quote-unquote level would stop and it reverts to every year.
Yes. And they use the word variable now because the regulator didn't love the fact that level premiums could move based on discretionary pricing. So, that's...
But the premium it would just mean that the premium wouldn't go up year on year because of age.
Correct. So stepped premiums and level premiums, we still use it internally at Skye because, as I said, we don't really understand the new terms either. But so step premiums means that your premiums will go up every single year. You're getting older. You're more likely to claim on those policies. So those quotes earlier that I mentioned were stepped, were the cheapest today. Now, premiums can go up for two other reasons. Now, if your level of cover goes up, so $1 million today, next year it's $1,030,000, then your premiums will go up accordingly based on your level of cover going up. Now, that's called indexation. And then the third reason your premiums can go up is a discretionary pricing from the insurance companies. So at the end of the day, the insurance companies, they price their own products. They try and make it accurate today. But in the future, if they become unprofitable, they can say to the collective group, we need to increase everyone's premiums. And that's what's been happening. There's been a lot more discretionary pricing over the last 10 years than had been prior to that. And so that's why the regulator came in and said, we've got to change this term level because it's not actually level. So
CommInsure used to have one a million years ago that was a true level, but also they increased eventually.
Well, yeah, true level means that the indexation
is based on the
original, the original age. So level premiums can go up for two reasons and two reasons only. So it can go up for discretionary pricing and it can go up because the level of cover goes up. But it can't go up because you're getting older, just because you're getting older. So historically we liked, my policies are on level.
Yeah, mine
your
are all
policies
on level.
on level. Historically we did like level premiums. But there is a question about pricing that we may get into a bit more deeper into this. But at Skye, we now look at a lot of the stepped pricing because the differential between level and stepped is becoming really difficult for a whole bunch of reasons because of the discretionary pricing, and insurance companies are doing kind of initial selection discounts as well. So it does make it very difficult.
And this is the problem, like the insurance industry at the moment in Australia, it's so bad. Most companies have a new business discount. So, we'll give you a 20% discount for the first year or 3 years or whatever they choose, 5 years. Then overnight, your premium will just jack up. It's just so outrageous. It's so bad. And they're all doing it.
Yeah. 100%.
Are there any that aren't doing it?
There was one that wasn't doing it, and they, for 5 years, were screaming, kicking and yelling, saying everyone else is doing it, but we're the only ones who weren't. And then just end of last year, they brought out their initial selection discount.
Yeah.
So they jumped on board because, they had to. At the end of the day, if everyone else is pricing a product in a certain way, you just can't.
The market will follow.
Yeah, you've got to follow as an insurer. So it is a difficult situation.
So speak with your advisor. You might go to an advisor to get insurance that isn't through Skye Wealth. Ask them to explain why they've selected why they have. And I think historically, advisors have just done a really bad job of explaining level because people were getting shocked. Oh, you said this wouldn't go up each year, and then 3 years of consecutive increases. I always used to sell it as this premium will never increase because of your age. Simple as that.
Yeah, I think advisors in the last 5 years have not sold it that way because we've all seen it move. But historically, yeah, those prices weren't moving. When you were giving advice, the prices weren't moving. So why would you communicate it any different?
But it would increase each year because of the CPI index.
Correct.
And the new added bit of CPI was based at your age today, not at the start date of the policy, which is level. So...
But even that CPI increase, that is the pricing that is, the policyholder can turn off that CPI increase. So you can always have some level of flexibility with level where your premiums theoretically could never increase if your level of cover didn't go up.
100%.
Until these discretionary pricing came
We used to actually have fixed term level where you could say, I want a 5-year or 10-year. And that was the old school term life because of the term of the policy. Health conditions. Belinda said, would love to know how on earth you get decent cover after health dramas. Josh also said, how do individual factors like high BMI affect an application and premium? So talk to us about those two questions there.
Yeah, so I'll just go to first Josh's question about high BMI. So there is a loading that the insurance companies place. So they just charge a higher premium based on a high BMI. So different insurers have a range of what they call healthy BMI, and then they have an upper limit where they won't load it, and then over that limit they'll start loading, so a 50% premium increase. So that's normally how they manage that BMI rating. When it comes to how do you get good cover after health dramas, I mean, it really depends on what health dramas. Some are more significant from an insurance point of view than others. So, things like if you've had cancer, then it's going to be very difficult for an insurer to cover you within a certain number of years. But if there are some things like, breaking an ankle, then, maybe you'll get an exclusion within the first 12 months, but symptom treatment free, the insurance company won't negatively impact.
Or even if you had a high BMI, because statistically, the data says high BMI, there is a higher chance of a medical event.
Yes.
Statistically.
Yeah.
And sure, BMI might not be the best measure of whatever, but here we are. We see it sometimes. We had someone the other day reach out to me after they had seen your business, and I had seen these words in the Facebook group and other, I would say, issues or complaints where people have been declined cover based on health. They start talking about human rights. Now, when it comes to insurance companies, human rights is cute, but if you have high blood pressure, the data says you've got a higher chance of needing to claim, therefore we have to charge you more.
Yeah. Yeah. I mean,
so how do we dance around this? You are declining me cover. That's a violation of my human rights, as opposed to, well, the data says this.
Yeah, the human right is about discrimination. You can't discriminate against someone really willy-nilly. Now, insurers have an exemption when it comes to discrimination. They can discriminate against anyone as long as they've got scientific evidence to discriminate
based
against
on the actuarial stuff.
Yeah, based on their numbers. And insurance companies, they're not just like cowboys out on their own making these things up. They get reinsured. So global insurance companies will cover a lot of their cost when it comes to claims. And that's where they get a lot of the data from. So they have an ability to discriminate, which is exactly why males and females have different premium structures, because that's a level of discrimination. Occupations, being white collar versus a builder, that is discrimination.
Why do I have to pay more because I'm a bricklayer as opposed to an office worker? You're discriminating against me.
And 100% it is, but the insurers have the ability to discriminate and price discriminate because of that data that says that if you're a bricklayer, you're more likely to claim on these covers and therefore we'll charge you accordingly.
And it's very similar because I still do to this day explain it to people. It's like, just step back, house caught on fire. If you called the insurance company and you said, yeah, the house is currently on fire, can I insure it? What are they going to say?
Yeah, no, thank you, but no thank you.
No, thank you. Yeah. Because that means there would be a 100% chance of that insurance company paying out more than the $1,000 they would have received for that policy.
Yeah.
So it's an insurance pool that needs to be protected as much as possible.
That's
for the
right.
greater good of the pool, right?
Yeah, and a big one these days is mental health. This is a really big issue that all insurance companies are dealing with and managing their cost of mental health claims, because those costs are skyrocketing. And so when clients get, we even had new team members coming in, new young team members learning about insurance, and they're like, oh, how do we advocate for mental health? And so, I took their questions to the head of underwriting with a major insurer in Australia and say, hey, here are some questions that we're getting internally. How do we discuss this in mental health, and what are the claims experiences with other countries? Because they're a part of a global insurance company. And at the end of the day, the insurers can lean back on their claims statistics and says, we're paying out, I think, over the last 10 years, mental health claims for disability has increased 730% for 30 to 40-year-olds. And so that's data that they can lean on to say, hey, we need to be much more cautious to protect our pool of policyholders. Therefore, we're going to be quite strict on mental health treatment or symptom in the past, because we've got to protect that pool of insurance in the future. So, and it's all related, and that's discrimination.
Yeah.
And it's all related on to their claims data that they're seeing.
I had a phone call on Friday, and I actually haven't told you this. I was going to tell you in our on Facebook chat, and I'll tell you because it's just it's like a half industry story that talk to Phil about, and a half lesson about underwriting. So I rarely answer my phone with numbers that aren't in there, right? Because I just get ambushed. Like this phone call. Pick up the phone. Hey, Glen here. Oh, hey, Glen, it's X. I'm like, oh, hey, mate, how are you? Used to be a client of mine. Mm-hmm. And, a bit of a chat. Yeah, what are you up to? And it was a friend of my sister's, and all that. So I didn't mind just catching up. And he said, oh, hey, you set all those policies up for us, 10 years ago. We actually purchased a property in a self-managed super fund, and we just cancelled all the policies that you set up for us. And my instant reaction was, they were level premium, back in the good old days. Anyway, we're here now.
Yeah.
Never cancel your policies that are level premium.
Unless you talk to an advisor.
No, unless you're talking to an advisor, and unless there's a bloody good reason. But I know the ones that I would have set up.
No,
you don't touch them.
Yeah, not the old ones. Yeah.
No, not those ones. Anyway, so I said, yeah, that's all good. They said, oh, and I just wanted to ask you, we're going through this advisor at the moment, and they're asking all these bloody questions and all this, and have you got a recommendation for another person to go through? And I instantly thought, well, it's not the advisor issue, it's the underwriting process. And I said, oh, look, just who's the insurance company? Because he said the advisor in North Sydney or something like that. And I said, look, just forget it all and go to Skye Wealth. No, I didn't say that.
I was going to say, they're already through the process. Go.
And she's in the background. I won't say their names. She's like, oh, Clearview. I'm like, Clearview. I say, awesome. So the advisor has recommended Clearview as the insurance company. What you're going through now is normal underwriting. And he goes, yeah, they just want to know all these questions. And I said a couple of things. As we get older, we have more complex health things. And I said, I'm not introducing you to another advisor because it's not an advisor problem. This is a medical underwriting thing that you're going through. So I said, what you need to realize is, because then he goes, my staff, we use the CBUS super for group for the employer super. Should I just go through CBUS? I was like, no, continue the process if it takes a little bit of time, because if either of you died prematurely or whatever, we don't want to do all this process at the time of claim. We want to make sure that they've got as much information as possible. They can issue the policy, and then at claim time, we don't have to do all this digging.
And if you got real levels of cover within CBUS, you'd be doing all the same thing anyway. So
yeah, long story short, he basically is like, all right, I'll just keep on keeping on. But I said to him, because I couldn't help myself, I'm like, who's the frigging person that set up the super fund for you? You could have transferred the policies that I set up to be paid from the self-managed super fund, not just cancel. Anyway, But all that to say, with the mental health thing, I had a claim, an ex-client of mine, because, I had a good relationship with a lot of my clients. They called me the other day, full TPD claim of the policy that I set up for them for mental health, PTSD. And they had the certainty at claim time. Met the definition, no pre-existing illness on mental health.
Yeah.
Claim paid.
Yeah.
So it sucks. I personally have a mental health exclusion on half my cover. The first half was before I knew that I had depression, anxiety, and all that. So any cover after I knew about it had an exclusion on there. So to Belinda's question, would love to know how you get decent cover after health dramas. You take what you can get with an exclusion.
Yeah, and work with an advisor who's going to ask all the questions up front, because the difference between the insurers is pretty vast. And so, yeah, it's super important that working with an advisor. Simone actually asked the question, why can't insurance inside super be transferred like super itself without new medicals?
Well, it can if you set up a policy through an advisor that's outside that super fund, but I'll go to you for the professional answer.
So if you've got an Australian super account and you've got a policy through Australian super, it's not Australian super that owns the policy. They're not the insurer. It's actually TAL, who's a major insurer or the biggest insurer in Australia. So you can't transfer that TAL policy into a Host Plus super because their insurer is MetLife. So it's a very different insurance company. So they want to understand the risk. Even if you went from Australian super to another super fund that both had TAL, there's still different pools of insurance, still different groups policies. So that's why you can't transfer if you're moving, if you have the policy through the super. Now, if you go through an advisor, we can set up policies, as you said earlier, Glenn, where we can own it through the super fund. So Australian super can kind of pay for the premiums, but it can be moved across. So if I go from Australian super to Host Plus or any super fund, then we just sign one form to say, hey, now pay the premiums for this
I always think,
fund.
what's a really easy way to explain it to people so they totally get it? And I still struggle with this. It's almost like the advisor the insurance company provides a superannuation product or a superannuation fund, but there is no investment component at all. The only thing in that fund is an insurance policy. So each year, like, you can roll your super over, you can roll a portion of your super over to the fund, the super fund that the insurance company set up, which just has insurance in it.
Yeah, exactly. So,
and if you log into your ATO, you will see your Australian super or whatever there, and that's the balance. And you'll see another policy, TAL Super, Clearview Super. Yeah. So that's exactly what it is.
And it's the best way, especially for young people who may want to move their super around, because at the end of the day, super is an investment vehicle. If I really like Australian super and the way they invest my money, great, I want to go there. If I want to set up a self-managed super fund like your friend did and go and buy investment properties or whatever they want to do, having your insurance not linked to that account but still being paid by that account is incredibly important.
I still do a yearly partial rollover from my super fund to my super trustee policy. It was easier than cancelling and reissuing the policy owned by the super fund.
Oh, because you got a self-managed super fund.
Yeah, that's right. Yeah. So.
Yeah, you can do both. When you got a self-managed super fund, you can manually make that payment, or you can just own it through that super fund.
Yeah, and then the money will get debited from the super fund bank account.
Yeah.
But it was just 6 one, half a dozen the other. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.